Okay. So this meeting is being recorded. Let's start now. So any questions from previous class or assignment or anything at all from anybody? No? Okay. 6:35, I think I should start it. All right. Okay. Is this big enough for you all to see? Is it big enough?
Yeah, that's fine. Thank you.
Okay, let's start the video and start talking about it now. Okay. Today we'll be discussing about the cost of capital. All right. In previous class, we discussed about, in last classes, we discussed about bond valuation. We discussed about project evaluation. And when we discussed about evaluations, like capital budgeting, project evaluations, we applied different types of methods. What these methods are is payback period method, net present value method, then IRR method, internal rate of return method, annualized net present value method. We discussed risk-adjusted discount rate. Okay, these are the various methods we have discussed in last week. This week we'll be talking about WACC. Okay, what is WACC? Okay, so now look at here. Before we go to the WACC, I would like to introduce you to another concept. This is called cost of capital. What is this? Say the cost of capital. A firm's cost of capital is the minimum return required by investors to compensate them for providing capital to the firm. How do they mean? They mean like this. Let me explain you a little bit more. How do they mean by this? They mean this way. Let's say that you want to make an investment in a business. You're going to make an investment in a business. Now, you will not, as a business person, you are not doing charity. You are doing the real business in here. So you are not going to actually invest to this business until you are sure, until you are assured, or you have an intention, or you have a confidence, a faith, okay, that you will be paid for this investment. Okay, you will be paid for this investment. And now the problem comes up in this way. The problem comes up when you see it's a risky project, you're expecting risky rate, you're at a higher rate of return. This is the investors' point of view. But the investors, the people who will be buying your shares, they're the investors. Investors are those people who will be buying your share. If you are the investor, so you are actually the buyer of the share. You're buying the shares. So you are not going to buy a share that actually gives you no benefit. No, you're not. You're not going to do that. Okay? You will be smart enough to invest in such a place, you will be invest in such a security or share that will give you some benefit, earnings. This is investor's point of view. Okay. Now, if you think other side, from others' perspective, okay. If you think from the firm's perspective, you have to sell your share, and you know it very well that who are going to invest in your firm, they will not invest until they get some rate of return. They get some return. So firm is under pressure to earn more than the rate of return that they will have to pay. Forget about investors. Even they take a loan from a bank, for example. Bank interest rate is 8%. So the firm will have to earn more than 8% because they have to pay for the capital they have collected from the bank as a loan. Same as investor too. If the investors are expecting around 10%, if investors are expecting around 10% of interest, definitely firm will have to earn more than that. Or at least that much they will have to earn to be at least break even. So they say here, firm's cost of capital is the minimum return required by investors. Cost of capital, what is cost of capital? That minimum return required by the investors to compensate them. Why to compensate them? For giving them the capital. They have given the capital to them. Okay. So it says, generally speaking, investors will require a return that compensates them for risk associated with the investment and capital market conditions, including expected future inflation. So they know that they're taking some risk, making investment in a firm, and they're expecting that the firm will be actually paying them. Firm will be paying them the required return. That's the whole case. So what is your cost of capital? Your cost of capital is minimum requirement, or how much, or you can say in simple, or you can say this way, how much you have to pay for the capital you borrowed from others, borrowed or taken the money from others. Borrowed in the sense, if you take the money from the bank as a loan, long-term loan. Or you have some investors bought the share and you have to pay them for the shares. There are two different types of shares: ordinary shares and preferential. That's what we'll be discussing in this topic today. So now, it says the cost of capital is the rate of return the firm must earn on its project investment to maintain the market value of its share. This is, I'm talking about this highlighted one. This one I'm talking about, the highlighted one. What this says here, the cost of capital is the rate of return the firm must earn on its project investment. Yes. This much I agree. I already explained this much. The cost of capital is the rate of return the firm must earn on its project investment. I understand this part. But the next they said, to maintain the market value of its share. Very interesting topic in here, the last part. To maintain the market value of its share. Look, you as an investor will be attracted to those type of shares that gives a good dividend, good return. If the project fails to return your rate of return, if the project fails to provide you with the required rate of return that you are expecting, 8% or 10%, whatever you're expecting, if it fails to provide you that, what you're going to do? You will not be attracted or demanding this type of share. When the demand goes down, definitely share price will go down. Okay, that's the story here. Demand goes down, share price will be going down too. So this says to maintain the market value of a share, the cost of capital or the rate of return, the firm must have to earn. Okay. So I hope these things are clear in this side. Now let's move on to here. If the rate of return of the project, assuming risk remains constant, the cost of capital implies value of the firm will increase, the vice versa. What do they mean? What they're saying here? If the rate of return of the project, okay, is greater than the cost of capital implies, look, two things here. One is income of the whole project. Another thing is the cost of capital. Cost of capital means how much you will have to pay to those people or to those banks from whom you took the money to start the business, to pay them some. That is the cost of capital. And your firm's income, the rate of return of the project you have started with by taking the money from those people, this rate of return of the project has another income. How much the project is earning. It will be, whole project is earning more than the cost of capital. Look, if the project earns 10% and they have to pay the 10% to the cost of capital, the firm is left with nothing. There is no value is added to the firm. If the firm earns 12% or 15% income, the rate of return of the firm, and they pays 10% to the cost of capital, the people who actually given them the money, so what is left with? Extra money is left with, and these extra money will be added to the firm's retained earnings, firm's values. Okay? Yes. It's a very simple concept. Can they say another? This says if the net present value is greater than 0, or IRR, internal rate of return, is greater than the cost of capital, means share price is going to increase. You understand? And what else? Okay, so this is so I hope this what is cost of capital is very clear to you guys. Cost of capital is the how much you have to pay for the capital you have taken from other people. What is the rate? If you take from a bank, it's rate of interest you have to pay to them. If you take it from investors, preference shares, you have to see how much you promise them to pay. Ordinary shares, you have to decide how much expected dividend you have to pay to them. Okay. Yeah, that's nothing much in there. And what else? No. Key assumptions, 3 things. Very interesting. Yeah. Business risk, financial risk, and after-tax costs are relevant since the cost of capital is measured on the after-tax basis. Look, this says here, business risk, cost of capital is a dynamic concept and affected by a variety of economic and firm-specific factors. Cost of capital is a dynamic concept and affected by a variety of economic and firm-specific factors. So one of the assumptions is business risk. What is business risk? Business risk is that when the firm will fail, when the firm will be failing and it cannot pay its operating cost. That's business risk. Okay. That's a business risk. I think they mentioned somewhere. Okay. The undertaking here, the business risk, the undertaking of an investment project will not change the business risk associated with the firm's assets. I'll come up to this point very soon. Okay, I'll talk about this topic very soon. But before this topic, I would like to talk something more. What is included in a capital? Okay. We are interested in determining a cost of capital applicable to analyze of long-term project. We are interested in determining a cost of capital applicable to analysis of long-term project. Therefore, we are concerned with source of capital that are used to finance long-term investments. Therefore, we are concerned with source of capital that are used to finance long-term capital. So we have three different types of long-term capital. Generally, this will include the following permanent source of capital when calculating a firm's cost of capital. What are the different types of long-term investment? Number one, long-term debts. Number one is long-term debt. Number two, preference share. Number three, ordinary share. These three things are the main. Then we have retained earnings as well. I told a little bit about retained earnings, not much. Retained earnings also another source of capital. Okay. And short-term one, we said here, short-term non-interest bearing liabilities. Short-term non-interest bearing liabilities such as accounts payable, accrued wages. The other short-term, just short-term cash flows, they say here. Like accounts payable, you don't pay the accounts. You have some creditors, you don't pay them now. The short-term obligation for you, short-term liabilities for you. Since you did not pay them, this money you could be using for some other purpose. But this is not a long-term project investment. You have to pay them within a month or two. So you cannot actually rely on these type of things. You did not pay your staff. Okay, you did not pay your staff accrued wages for maybe 1 week, 2 weeks, 3 weeks, 1 month, but you have to pay them back. Okay, so these things are not actually covered in here when you talk about collecting money. Okay. Yes. Yes. So we can actually go for a good combination of three, or we could go any one. It depends on which one we have to go. Now, you can ask me a question. Let's say that you have three options: long-term debt, preference shares, and ordinary shares. Three options you have. And you need $10 million. If you go for long-term debt, you have to pay 10% interest. If you go for preference share, you have to pay them 11% return on the amount they paid, on the par value of the share. If you go for ordinary shares, you have to pay 8%. Now you can ask me a question then, why we have to go for a combination? You can go straight to one. Get all the money, all the 10 million from by issuing ordinary shares. That's our next topic is. Why not simply use the cost of the least cost source of finance at a point in time? Why we are not using the cost of least cost source? Look, it may not be possible all the time. When you actually set up your company, that time they will give you a restriction. How much share you can issue, how much ordinary shares you can issue, how much preferred share you can issue. These will be actually provided. You have given. Okay, how much is paid up capital, how much you're allowed to collect money from public. There will be some limitations. So you cannot. It might happen that you may not get all your required money from one source. Like we said in here, for example, there is normally a limit on how much a firm can borrow from a bank. So yes, if you say I'll get all the money from the bank, long-term debt, there is a limit how much you can borrow from a bank. So what normally they do? They go for a combinations. And here I showed you an example in here. Is if this is the case, I have to get $10 million. I can get long-term debt from $2 million from long-term debt, $1 million from preference share, $7 million from ordinary shares. Look at here, I have taken majority of my capital from the minimum rate of return, 8%, minimum cost of capital. See that? I will take maximum money I have taken from the minimum interest rate, 8%. Three options, 8, 10, and 11%. So I will take most of my money from the minimum source, minimum cost of capital, 8%, which is 70% of my total capital, required capital. Preference share 11%, the highest. I'll take 1 million from there, as less as I can. This is an example I'm giving. 10% long-term debt I have to pay. I'll take 2 million from there, which is 20% of my total capital. Okay. So the rate of return that you have to pay back is known as, for long-term debt, known as RI. I for interest. Preference share 11%. In this example, we actually denote them as RP, preference share for P. Ordinary share is RS share. And this proportion, the percentage of your total capital requirement is known as, look at here, weight is known as weight. 20% weight is coming from interest. 10% is coming from preference share. 70% is coming from shares only. And you can see here that we will be making a combination. How they do this? The managers of a firm will generally determine what they believe is the appropriate mix of financing. So it's the manager's decision how they're going to choose it. So this is I have given an example in here. This is a basic example I have given. Okay. So manager will decide what they want to do. It depends on their target, what they want to gain, target capital structure. That is consistent with the long-term goal of the maximizing the value of the firm. Some firm might say, I will go for higher interest rate, maximum money. Why? Maybe he wants to give a less tax. You have to pay less tax, maybe. Okay, so it depends on their strategies. Okay. All right. So what they do normally, how do they calculate? Then when you have these three different types of cost of capital, which one you say your cost of capital is, then you do not say any of them. You actually use WACC. What is WACC? Weighted average cost of capital. You multiply with this 10%, 20%, 11%, 10%. You multiply. There is a formula for this. What the formula is? The formula is in here. This is the formula. Okay. RA is known as weighted average cost of capital, WACC. WACC is represented as RA. See, WIRI plus WPRP plus WSRS. So you add this all up, then you get the WA. That's how you calculate it. Okay. In my example, I don't know, here is an example they have given. This may not match with my one. Okay. So they have given you here, WI, it means 30% of their, let's go back in here. I can see here that 30% of the investment is coming from 7% interest rate. 10% is coming from 7.5% interest rate. 60% is coming from 12% interest rate. You see that? So majority of their capital is coming from 12%. Why do they do this? Let's talk a little bit more about why did they do these things. Okay, let's talk a little bit more. It will be clear to you guys why sometimes they want to go for a higher rate. Okay. Well, we talked about three things is going to actually have impact on the now. Which combination you choose has nothing to do with business risk. Now I'm gonna talk about these three things: business risk, financial risk, and after-tax cost. Okay, these three things I'm gonna talk now. Okay. So what is business risk? Business risk is the risk of the firm being unable to cover operating cost. When the business cannot cover it or cannot raise its operating cost, we say that business is having a risk. Okay. So this undertaking of an investment project will not change the business risk associated with the firm's asset. So what project you take and how you decide your capital structure has nothing to do with business risk. Same as financial risk as well. What is financial risk? Financial risk is that when you are not able to, when the business is not able to fulfill or unable to cover required financial obligations. Financial obligations means the obligations they have taken in financial sectors. For example, interest they have to pay to the bank. They can't pay the interest of the bank. They can't pay the lease payment. They can't pay the preferred share dividends. So these are the financial risks they have. Financial obligations they have that needs to be paid. When the firm starts to fail to pay off this financial obligation, we know that financial risk. They say it here clearly. Financial risk will not change if financing a new project does not change the mix of financing of the firm assets. For example, does not change the firm's capital structure. So financial risk will not change. If you do not change the financial capital structure. You have to change the capital structure in there. And the last one, this is very interesting and important one. This one. Okay. This is says only after company tax costs are relevant to the calculation of the firm's cost of capital. Only after company tax cost. How do they mean by after company tax cost? What is that? Let's go through a little bit more in depth here. Okay. Let's go through a little bit more in depth. What this says here is this. I'll take you to this one, this example. Okay. So this says, for example, let's say you took a loan of $1,000. And your interest expense paid is how much? 10%, which is $100. You took a $1,000 loan and you have to pay $100 interest expense. Okay. And company tax is 30%. That's fine. Now remember one thing here, interest expense is tax deductible and it will reduce your taxable income. So if your company has made a profit of, let's say company made a profit of $3,000, you have to pay $900 as tax, 30% tax. But if your company have interest expense of $100, then you don't have to pay this $900. You have to pay less. How much less you have to pay? $30 less. Because 30%. So this says here, look at this, interest expense $100 and tax would be $30 of this $100. Right? Profit would be $100 more and tax savings is $30. So if the profit is $100 more, if you don't pay the interest, it means you have to pay $30 more tax. If profit is $100 less because of interest expense, you pay $30 less tax. So the question comes up, if you are saving, that's because you are taking a loan and you are saving these $30, then what happens in this case? The real interest expense is actually $70, 70%. $7% is interest here, not your 10%. Okay. So that's how they say this in here. So it is actually more explained in later on in here. Yeah, they explain it better. So interest expenses, look, RD into 1 minus T. Okay. What is this? It says here, as a simple example, suppose a firm, like the example I gave you here, faces a tax of 30% and pays $100 interest on its $1,000 debt, representing an interest charge before tax cost of debt is 10%. By claiming the $100 interest as a deduction from its taxable earnings, the firm's tax liability is reduced by $30. Thus, the net after tax interest expense associated with the debt is 100 minus 30, $70, representing an after tax cost of debt is 7%. See? That's what I was trying to say. So here you can see here RI. RI is your actually after tax rate of interest will be equal to rate of debt, cost of debt or financing, RD, into 1 minus tax rate, T. Okay. So this says here that three things in here, three assumptions we have. Now I will go back in here. Business risk, it has nothing to do what structure of capital structure you have chosen, has nothing to do with business risk. Business risk is actually operating cost. So if operating cost, it means like management is not efficient. Management is not efficient. They can't make a good decision to make a better operations, efficient operations. And business is losing money because of this. This is business. This has nothing to do how you collected your money. Nothing to do with that. Financial risk, well, in this case, you have obligations. For example, financial obligations like how much interest you're gonna pay, then how much lease you're gonna pay, how much lease payment you have to pay, how much dividend you have to pay. These things are involved in financial risk. So at that case, what happens is this, that you have to choose very carefully what will be your capital structure. So financial risk can be mitigated. A little bit can be mitigated by choosing the right capital structure. But the last one, after tax costs are also relevant since the cost of capital is measured on after tax basis. Make sense, guys? So these are the things, like last one is very important. I showed you that if you can actually make a 30% savings of your cost of debt. Okay. You can make actually 30% savings on your cost of debt. So these three things I hope is clear to you guys now. Okay. We have covered these things. The basic formula has been covered as well. Okay. Okay, now we will be talking about those three things. Remember the three things in here? Okay. Three ways. I think I have to mute some people. Okay, I'll mute them all. Yeah. I'll also take my video off. You see. So now, three ways to actually collect your money. Remember, for the three ways we talked about, three ways I talked about. Remember, long-term debt, preference shares, ordinary shares. Now we will be talking about these three things. Let's put it long-term debt, preference shares, and ordinary shares. Let's go in here. Cost of long-term debt, cost of capital for long-term debt. This one is a little bit tricky. Okay. This cost of long-term debt has another cost involved. Let's say you want to raise $10 million, like in our example I said. But you know what? You will not be able to raise $10 million. Why? Because the problem is this. Let's say 9,940,000. Look, the problem is this. There is another cost involved. to raise your long-term debt, to offer this share to other people, to offer this share to your investors, to offer your share to investors, you have some cost involved. What is this cost? Flotation cost. What is this flotation cost? This flotation cost is administrative cost. Okay. Flotation cost is actually administration cost. Like what? Well, let's put it this way, that when you issue the shares, you have some printing. You have to print the share certificate. You have to recruit one staff who will be selling the shares. You have to pay membership to the stock exchange to offer the share. The administrative cost involved in here. Then underwriting cost. What is underwriting cost? Underwriting cost is this. That let's say you need $10 million and each share is $10 and you offered 1 million share into the public. Public did not buy all of your share. Public bought only, let's say, 7 million. Public paid you $7 million. Still you are lacking $3 million. It means $10 each. It means 300,000 share has not been sold yet. Then what you do? Then there will be another investment banker. Investment bank. These investment bank will buy your shares. These are the people, they will give you a guarantee. If they do not buy, the bank will buy. Investment bank will buy your shares. So whether you can actually raise your 10 million from public or not, you have to keep a backup underwriter. Just in case, if you cannot buy, if you cannot get all your required money from public, so you just keep another one on the back as a backup. If you can, that's fine, but still you have to pay underwriter's guarantee cost. There is also another cost involved. So even all of your share is being issued, you will see still you have 60,000. If you, let's say in example, I said $9,940,000 you have raised. Public paid you 10 million, that's true, no doubt about it. But because of administrative expense and other expenses, how much in net how much you raised? $9,940,000, $60,000 less. Just an example I gave. It could be more, it could be less. I'm not sure. Okay. I think it will be more. Okay. So this is the example we have. So did you raise this all money? No. So this $60,000 that you less, which is 0.6%, is less. You see that? So 0.6% also your expense. This expense is also part of your long-term debt issue expense, like your cost of capital expense. Make sense? So this is actually will be increasing a little bit more. So cost of capital will be actually cost of capital that you have to pay to your shareholders or borrowers, and plus also you have, long-term debt. Yeah, that also you have to pay for your this flotation cost. Okay. Yes. Okay, method. So there are essentially two methods obtaining the before the tax cost of issuing new bond. Okay, so there is, okay, anyway, then we talked about here we discussed, then we talked about after tax, how it's going to affect us after tax things. We discussed already this one. Essentially two methods of obtaining before tax cost of issuing. Okay, two methods they're saying in here. One is using the current yield to maturity on similar risk bond. One method is there. Another method is finding interest rate. So you have to follow this formula in here. How much you can raise, that's called net proceeds. How much you're raising. Okay, that's called net proceeds. So this is the formula you have to apply. And it says here, I think somewhere they said we will not consider this further in this unit. So anyway, we will not be discussing these things in the unit. Yes. Now let's go on. Let's move on to other things now. So here we talked about, here they're talking in here regarding how you can calculate this RD, how you can calculate this RD by using scientific calculator or by using Excel, scientific calculator, or by using Excel sheet. I think the Excel rate function, these things. Okay. I would like to take you to the next topic, the cost of preference shares. This one. Okay, three things we'll be talking. We'll be talking about long-term debt, administrative expense, floating cost, and guarantee underwriting, these things. Preference share. Okay. Another thing I would like to mention here, in long-term, this one, if you take a loan from the bank, long-term debt, the administrative expenses are in there. Bank charge a lot of administrative expenses, and also underwriter here, the insurance companies gives you guarantee that you will be paying back to the bank. So it's not just only you 10% or 11% you're paying to the bank as interest. On top of it, you're paying administrative expense, administrative cost of the bank. You will see a lot of time, if you take a car loan or any other loan, you will see they will charge you administrative cost, $20 every month. Even for a personal loan, they do it. They offer you insurance as well, insurance protection as well, loan guarantee or loan protection. Insurance company does this thing. So that's also the part of these things. And these things also might come in your long-term and short preference ordinary shares as well. Okay. Now let's go on to this one, cost of preference shares. Now we are learning the cost of like the RI, RS, RP, these things you are trying to identify now. Okay, how to calculate those things. Okay. So cost of preference shares, this says two things, calculating the cost of existing preference shares, calculating the cost of existing preference share, and calculating the cost of new share too. Existing preference share and new issue of preference share. Okay. Preference share dividends are normally expressed as a percentage of the par value of the share. So it's very straightforward. Dividend, annual cash preference share dividend in dollars, DP. So it will be like how much, what is the rate, what percentage you're gonna pay, how much dividend has been paid, what dividend has been paid, and what was their RP, existing pair, current cost of existing preference share. That tells you about the current market price. Okay. So how much you pay, right? Price, how much dividend you saw. It's like simple, like what is dividend? How much money you're getting in return? The rate of return divided by how much you invested, the price you paid to buy it. Simple. DP by D, DP by P. But in this case in here, okay, when you issue new shares, okay, you are issuing new share. So here is the preferred dividend will be, let's say your dividend is, the example we have given here for the first one, existing share, existing preference share. What is your cost of capital for existing preference share? It says here. Suppose UWS incorporated preference shares are currently selling at a price of 20. Price has gone down. These shares pay an 8% dividend on a par value of $24. You can ask me a question, how come the share has been issued and how come they're again selling the share then? Secondary market you're talking about. Okay. Or unsold share, you can say unsold share as well. What is the cost of capital? The firm is issuing, checking the share they have sold, how much money they have taken from, how much money they have collected from public is $24 per share. You see, per value of share, which is $24. So people have taken, the people has paid, investors from outside has paid them $24, okay, and bought one share. And how much the company is paying? Company is paying 8% on $24. 8% on $24, it means $1.92. Okay, $1.92. And this says here, interesting thing in here, look, the price, market price, current market price of this share, which was actually sold at $24 par value, is now $20. If someone purchased this share now, they have to pay $20. How much the share will be paying dividend? 1.92, same. 8% on par value. So what is the rate? Rate is 1.92 is the earning by the share, and the current market price is 20, is 9.6%. Now, if we go on the next one, it says here, in this case, calculating the cost of new issue of preference share, now issuing new shares. Okay. In this case, if we let NP be the net proceeds per new preference shares, I must have done something anyway. Okay. Let's see why it went to the another page. Okay, let's take it out. Okay. Actually, I'll take the whole thing in the next page, so it will be easier for us to see everything in one page. Okay, this will be good. Yeah, this is good. This is the whole thing about this one. A new share. Yeah, this is nice. And this is other two, existing ordinary share. This is ordinary shares. Existing ordinary and these things. Okay, fine. This ordinary CAPM method. This cost of retained earnings is another topic. Cost of new ordinary is another topic. That's it. Let's go back in here. I'm just separating them. What are the different topics we're discussing? Is cost of preference share. Then before that, we talked about this one. Okay. So this was about issuing long-term debts. This is the one. This is a long-term debt. This is one of them. Then you're talking about cost of preference share, the existing one, and this topic is here, new one, when you issue new shares. Okay, it's very simple here. Same rule applies here. How much dividend you are getting, but for existing share, how much is your current market price of the share? But for the new issue of preference share, will be how much will be your net proceeds. How do they mean? Example is in here. Let's do this example. This says here, suppose UWS Incorporated can sell new preference shares with a par value of $24, same, par value $24 for $20 each, and these shares will pay an 8% dividend. This share will pay how much? 8% dividend. calculate the cost of these new preference shares if flotation costs are 20 cents per share issued. How much is flotation cost? 20 cents per share. Okay, 20 cents per share is your flotation cost. So even you are selling a share, the par value of the share is how much? $24. And you're selling for how much? You're selling it for $20. Okay. But the question, are you getting $20 as a firm? Public is paying you, investors is paying you $20. But the question is, are you receiving $20? No, you are not. How much you receiving? You are receiving $19.80 because you are paying 20 cents per share as flotation cost. What is flotation cost? Administrative expenses, underwriting expenses, other expenses involved in here. To issue shares, you also have some expense involved. See? So it will be 1.92, that's the dividend you're gonna pay, but how much you received? 1980. That's how you calculate the rate. It is 9.69. Okay, 9.697. That's your preference shares. Now, we'll talk about cost of existing ordinary shares in this one. I will not spend much time on this one, to be honest, because the first thing is this. We have already done it before. In last two classes, we have done this thing before. Discounted cash flow approach and CAPM approach. Two approaches in here. Discounted cash flow approach and CAPM approach. So what is these things? Discounted cash flow approach, what is this? So we did it before. See this here? Okay. Gordon method. And here is a constant growth method. Two methods to say. So this is discounted cash flow approach in here. Price of your share, present value of your share will be, you have to discount your future dividend inflow. After 1 year, how much dividend you are getting? Divided by 1 plus RS. RS means your rate of shares. Okay. RS. So let's say it in here. That's your dividend. Yeah. As we have seen previously, to use this equation, we have to make some assumptions about expected future dividends. Okay. Most commonly, the constant dividend growth model is assumed, in which case the above valuation equation becomes G is the assumed future annual growth rate of the dividend. So this is a constant growth rate method they're giving you. So yeah, so they give an example in here again. We have done this example in our previous two classes, two lectures. Two lectures, also two workshops, we have done these things a couple of times. Okay. Another one is, so example here is very straightforward example. Growth rate is given. Dividend is given. Okay. So you calculate your D1 by P0 plus G. You calculate your rate of interest. It's always given a plug and play. CAPM method, capital asset pricing method, we have done this one as well before. Okay. Expected return will be equal to risk-free return plus beta into market portfolio, market return minus risk-free return. So yes, here is also the same. The CAPM approach estimate UW is incorporated cost of ordinary share given as risk-free return is 0.6%, market return is 10%, beta is 1.5. What is the answer? The simple calculations in here. Okay, so we have learned so far 3 ways: long-term debt, what will be the cost of capital using long-term debt, how to calculate those things. So look, how you're learning, look in here, I would like to talk in here, these things I would like to bring up. This one. Can I make it bigger? No, but I will make it bigger because I want to show you a bigger picture in here. Oh God, no, don't do that to me now. Okay, let's make it smaller, a little bit more smaller, a little bit more. Okay, here it is. It's better now. Can you make it red? No. Okay. Look, in this case, can you make it bold? No. Okay. Look, this is our WACC formula, right? W is very straightforward. What proportion of your money coming from which source? Is RI is a long term, P preference share, S ordinary share. See, WI, WP, WS, you can understand from there. But the problem is comes up to calculate RI, RP, and RS. That's why we are learning how to calculate RI, RP, and RS. Make it sure. Okay. So you look at here, the first one when you talk about cost of long-term cost of long-term debt, we are actually calculating here. Which one? We are learning to calculate here. RI. We are learning here RI. Then how many ways you can calculate RI? It depends on a couple of situations they have given you here. Okay, RI1 is this way. R equal to RD1 minus T if it is tax is provided. Another way for net proceeds way, but we do not use this one any further of this in this chapter in this book. Another method is that cost of preference share. If it is for existing, so here you are trying to calculate here. Which one are trying to calculate? Here is RP. This one you are trying to calculate RP. Okay. And RP can be calculated in 2 situations. If it is for existing, previously issued preference share, or it is newly issued preference share. That's it, done. Okay. Then we learn about ordinary share. This is actually how to calculate RS. RS. 2 ways: discounted cash flow or CAPM. Now we're learning another method. Then you say, if you remember, I said it to you at the beginning of the class, that not necessarily all the time it will be just these 3 methods to gain your money. Retained earnings is another option. You can get the money for retained earnings. What is retained earnings? Retained earnings means that after the profit, after issuing you dividend from the profit, still you will, let's say, still you will be left with some money. This money will be actually accumulated or saved by the business for their future protections. Like what? For example, let's say your business has earned $10 million as a profit. You are not going to distribute this $10 million among the shareholders. No. What are you going to do? Maybe you will give them $3 million. Out of the rest $7 million, you will take, let's say, another $4 million, you will save it, keep it. Okay? And rest of the money you reinvest into the business. So some money you are saving all the time, every year you're saving it. This is called retained earnings. You're keeping it. This increases the value of your business. And it increases your business equity too. So when you need money, if you don't want to issue any share or want to take any loan from the bank, you take the money from the retained earnings, like a reserve, like an Australian government is giving trillions of dollars now to public. Where the money coming from? It's the savings, reserve money. When the country is in problem, they're using that money. Exactly, the business has the same situation. Even in human life, we have the same thing, retained earnings. You keep this, you retain these earnings, keep some earnings. Okay. And I don't think there is much involved in here. The cost of retained earnings, RS, is taken as being equal to the cost of existing ordinary equity. So they take it like retained earnings will be at the same rate of ordinary shares. Okay. The cost of new ordinary share issues. So they gave it here. Another example is at constant growth rate. If ordinary share financing is to be obtained from a new issue of share, the effect of underpricing and flotation cost should be taken account or in determining net proceeds from the issues. You have to be careful about your flotation cost, okay, and your net proceeds from the issues, how much you're getting actually. Underpricing of new issues is normal since in a demand supply sense. What underpricing means? Underpricing means even if your share is, let's say, $10 ordinary share, but you're selling it at $9, underpricing them. It happens. So it depends on the market demand and supply. In a demand and supply sense, increasing the supply of shares would normally result in a fall in the equilibrium share price below its existing levels. Okay. For example, it's almost 8 o'clock. Okay, I have to do couple more. I don't think I will actually show you this demand and supply diagram at this moment. Okay, I'll give it a go. Let's see how it goes. Okay. So let's see, this is your, no. This is your demand, this is your demand and supply diagram. So that's your price. And this is here your quantity demanded. That's your quantity. So let's say that this is your demand curve of the share. And this is your supply curve of the share, for example. This is the situation you have. Okay. And you will see here that this is your quantity demanded, and this is your price of the share. This is the price of the share. So if the demand of the share increases, why the demand of the share will increase? Demand of the share might decrease too. It depends on the situation. Let's say I say a demand of the share increases. At that case, you will see that demand of the share has increased. So demand curve will be shifting to the right. And you will see that now on new situation, you can see here, price is in here, price has increased. Quantity has increased too. See, the price has gone up. See? If the demand actually goes down or the supply increases, you'll see the price will be falling off. Let's say supply decreases, another situation. And actually, I will say here the demand has actually gone down, demand and supply situation. Let's do this demand side here now. And we have it here. Which color I should use now? I'll use this color and let's see it. The demand has, let's say, for example, gone down in here in this situation, the purple color. This is parallel. Oh gosh, I have written this thing wrong. This should be actually, this is not an arrow, actually, it should not be an arrow. I'm sorry. Let's delete it. It should not be an arrow, it should be a line. Let's see, demand curve of the demand has gone down this side. See that? So demand curve shifted, actually left. So you see the new price in here is this. Let's see now. So price, you can see here the price has gone down too. So I've showed you both the situation. Okay, the price might go down too. It's underpricing. So this three situation I have showed you here. Okay. All right. Now I will go back to our screen again. But yeah, so it might happen that you are actually issuing shares at underpricing. It depends on the demand and supply situation of the market at the situation at that time. New share issues dilutes the percentage ownership of the existing shareholders unless they buy the new shares. Okay, so now what happens is this: now when you issue new shares, the new shareholders will be coming up. When the new shareholders comes up, new participants come into the company, then dividend per share will be decreasing too. Don't forget that. Okay. Investors may view a new share as a signal that the firm's managers believe the firm's share are currently overvalued by the market. Like we adapt to the constant dividend growth model approach. So this is a constant dividend growth model you're going to use. We calculate RN by these things. All right, now let's go back to the last situation in here. Okay. They said with reference to the previous examples in the section, suppose UWS Incorporated is to raise new capital using a mixture of the new bond issues, a new preference share issue, and retained earnings with the following weight being applicable. So they're giving you WI, WP, and WT. Calculate the weight in the situation. Use the cost of retained earnings given by the CAPM approach. So look at here, CAPM approach. So when we did the CAPM, here is CAPM approach. So we use 10.6%. So they said use these things, 10.6%. Preference share 9.9697%. Issuing of new preference share rate. Okay. And here, long-term loan is this percentage they said. So we have actually using here RI, RP, and RS that we have actually calculated or derived from our previous examples. So they said using those percentage, calculate the new WACC. Okay. Then I told you already that we are actually learning these things, different methods, how to calculate this RI, RP, and RS. Okay. These things we have actually calculated from our previous examples. Using those examples, calculate if WI equal to 40, WP equal to 10, and WS equal to 0.5%. So you are actually getting 40% of your new capital from long-term debt, 10% from your preference shares, and 50% from issuing your ordinary shares. Okay. And this is the new WACC you will get, which is 8.1%. You will see. Okay, that's it about the cost of capital from this chapter. Yes. Now we'll be discussing about our examples. These things is here from because of my previous class. Yesterday I had a class on the same topic from there. Okay. All right. Let me do our attendance first before I use these things. Here. Dropbox. Today is Thursday's class. Okay. And week starts on 4th of May. Danielle Bryan, you there? What do you mean by my mic doesn't work? Okay. All right. That's okay. Make sure you fix it next time. Hayong Hom Cho, you there? No. Thomas Kondal, you there? No. Gurlin Kaur?
Yeah.
Hello.
Thank you, Gurlin. Oh, no, this is Lee Phuong. Gurlin, okay, Gurlin is there.
Yeah, I'm Lee Phuong.
Yeah. And Lee Phuong is also there. That's good.
Hello, I am Gurleen here, present, sir.
Yes, I got you too.
Yeah.
Priscilla?
Yeah, I'm here.
Thank you, Priscilla. Bahi Imam? Bahi Imam, no. Then this is Welwin Karla Kose. Karya Kose. You there, Welwin?
Yes.
No? No. Then Ihan Lee.
Yes, Professor.
Thank you very much, Ihan Lee. Benkata Pusa. Benkata Pusa, you there? No. Ananya Rizal. You there? No. Timothy Smith.
Yeah, here.
Are you there, Timothy?
Yeah, here.
Thank you, Timothy. Jun Kayong. You there, Jun Kai?
Yeah, I'm here.
Thank you, Jun Kai. Then Xuan Bak.
I'm here.
Thank you, Xuan. Yu Heng Lin, you there?
Yeah, I'm here.
Thank you, Yu Heng. Li Hui Fei. Li Hui Fei, you there? No.
Yes, Professor.
What's your name? Is Li Hui Fei there?
Yes. Is a chat.
Can you please respond, because sometimes it's not it's just complicated to check the chatting every single student. Okay. I got it, but next time you talk, please. I know your mic is fine, you're talking. Can you please talk next time? Jacob Loveday.
Yep, I'm here.
Thank you very much, Jacob. Weijan Zhang. Weijan Zhang. No. Thank you very much for this attendance. Let's move back to our subject again. Okay. So the first question is the Northland Pumping Company is considering expanding its operation by purchasing a truck especially outfitted for work involving the unblocking of drains. The truck can be purchased for $140,000 fully equipped and would have a useful working life of 10 years. There would be no installation cost. This purchase price would be depreciated fully over the truck's working life using prime cost depreciation, and the truck would have an expected salvage value of $20,000 after 10 years. The company pays a tax rate of 30%. If the new truck were put into operation, an increase in net working capital of $8,000 would be required. Okay. Purchase and operation of the truck would increase the company's annual profit before depreciation and taxes by $28,000 over the useful life of the truck. For the project involving purchase and operations of the truck, calculate the initial investment. Initial investment you have to calculate, annual operating cash flow, and terminal net flow for capital budgeting purpose. Okay, let's do this one. I have done these things from, this is from the Wednesday's class actually. So initial investment is actually 140,000 plus 8,000. What did 140,000? We know it. 140,000 is coming from here. The truck can be purchased for 140,000. It's in here. Plus, we need another 8,000 for working capital in here. It comes from here. So these two together, 148,000. The next question is about annual operating cash inflow. Cash inflow. Annual operation, cash inflow and operating. Annual operating cash inflow will be annual net profit after tax plus annual depreciation. Annual net profit after tax plus annual depreciation. So how do we get annual net profit after tax? We'll see that. And annual depreciation we can calculate easily, which has been mentioned here. That the company's price of the truck is 140,000, and it is for 10 years lifelong. It will be 140,000 divided by 10 years. It will be how much? 14,000 per year. Okay, so you got it, $140,000. And annual net profit before tax, they said here, 28,000 profit minus the annual expenses, depreciation, which is $14,000. So net profit after tax will be 14,000 into 70%. Why 70%? Because we will actually using here like 1 minus 30% tax rate. So I actually made a shortcut in here, which is, you can say, you can actually write it down here. You don't have to say 70%. You can say 1 minus 0.3. It's the same thing, 0.7. 9,800. So we know from our previous last week's lecture, last week's tutoring classes, what we learned, annual operating cash flow will be equal to annual net profit after tax plus 14,000 of your depreciation, 23,800. Okay. Terminal net cash flow for terminal net cash flow at the end, how much it will be? You see here, your salvage value is 20,000 after 10 years. So that's what the terminal value means, the last year values. 20,000 into 70%, 1 minus tax rate. Okay. Plus 8,000. What is 8,000 coming from? It is from here, this age. Is from there. increase the net working capital of 8,000. We require purchase operational truck would increase the company's annual profit, which is taxed by 28,000. So we actually have to do it by 28,000 minus this thing. Okay. So I think they actually added up in here, this working capital part is in here. But if we go back to our previous week, we can find it out in there. That's not 8, it should be. Let's go to the download. Yes. Not these ones. Discounted cash flow, this one here. Let's go to the previous week. 2094. Oh, 26. So you may have done this one of them. Okay. Terminal cost coming up in here. Yes. Operating cash flows, the terminal one is at the bottom one. This is terminal cash flow. All right. These things will be taxed on sale on old assets. Okay. And change in net working capital. Yeah, they added up working capital in here. So there's actually change in working capital that's been added up in here. Okay. Yeah. And supposing the appropriate cost of capital for the project involving purchase and operations of truck 9% per annum, calculate the net present value of the project. We said whether the project is acceptable or not by the net present value criteria. So we have to do the net present value calculation here. So look, since the truck is gonna give us actually $23,800 of profit every year. It mentioned in here $23,800. Where is that? Here we go.
Hello, dosto.
Annual operating cash inflows $23,800. You're gonna get every year.
Hello, dosto. Good evening. क्या खुल गए हैं सर है प्रोजेक्ट आज कल तक के लिए रोते कल तक के लिए रोते हुए मिले आज दारू की बोतलें रोते हुए मिले.
Okay, I think I should mute you all. All right. Okay, and since it is the same amount for every year, we use the annuity formula in here. Use the annuity formula for this part. Plus the last year terminal year's return. Terminal year's return is how much? $22,000. So these things are annuity plus terminal year's present value minus initial investment. Okay, that's why you got these figures in here. Okay. So remember the tricky part here is this is annuity formula we have used, and here we have used the present value formula and minus your initial investment. Assuming the project of purchasing and operating trucks is ongoing, in the sense that the truck would be replaced by a similar truck at the end of its working life. Now you have to calculate annual net present value. Okay, annualized net present value you have to calculate. Okay, so this is how do we do that? Annual net present value equal to net present value into R divided by, so that the formula is here, so all the values are provided, you get it like here. Annual net present value is, this is the one, 14,033.33. Okay, this one should be, we get this figure. Annualized net present value equal to net present value into rate divided by 1 minus 1 plus R to the power. So the same formula comes up in here. Now this one is very interesting one. Murdoch Paints is in the process of evaluating two mutually exclusive additions to their processing capacity. The firm's financial analysts have developed pessimistic, most likely, and optimistic estimates of the annual net cash inflows associated with each project. Okay. And what this says here, estimates are given in the following table: Project A and Project B. Initial investment is $8,000. That's the initial investment. Both the project A and B. And your outcome is, if it is pessimistic situation, then your outcome is, for project A, is $200. A million, thousand, doesn't matter. Most likely 1,000 and optimistic 1,800 for project A. For project B, pessimistic situation, 900. Most likely is 1,000 or optimistic is 1,100. Okay. Determine the range of annual net cash inflows for each of the two projects. So now here you go, net present values range. Range, what is range? Last week I said it was minus, I said just add if it is minus. Why? Because the formula for range is highest value minus lowest value. So highest here is 1,800, lowest is 200. So range for project A will be 1,600. And range for project B will be 1,100 minus 900, 200. Okay. Then they said, assume that the firm's cost of capital is 10% and the both projects have 20 years life. Oh gosh, 20 years. Construct a table similar to that above for the net present value for each project. So here is the answer is in here. Initial investment is 8,000, an outcome for pessimistic situation. This. How did you get this number? That's the project A, net present value. Okay. And project B, project A, net present value, pessimistic situation. This is the formula I have applied. It is cash inflow into 1 minus, okay, this one I can do differently actually. 1 minus 1 point, how did I get 1.1? Let's put it this way. You can say it like this. Okay, 1 minus, let's say 1 plus 0.1 bracket close, and you close your other bracket too. That's the case. Okay. So all of them the same formula, nothing different. Same formula all the case. R is equal to 10% the size. Okay. So your annuity for 20 years, annuity formula used here. Okay. And you can say here actually, it will be much more clear to everybody now. And if I go and put it like that, so yes, much better. Okay, this is the case you have. This is for project A. That's for project A. This is also for project A. And you can say here, multiplied. Okay. So here as multiplied. Yeah. For project B, exactly the same thing. Okay. Just change this figure and all, of course, don't forget to actually subtract the initial investment. One thousand into this. So, yeah. So this is the way I calculated my values. Okay. You can see here minus 6,297. How did I get it? This is the formula I got it. Pessimistic figure is 200. So here is 200 pessimistic. Yeah. Into 1 plus 1 plus 1 plus I, r to the power minus n divided by I, or r, whatever you say. Pessimistic, most likely optimistic. For project B again, pessimistic, most likely optimistic. And then says about the net present value range, highest minus lowest. So highest is equal to is 7,324.41, and the lowest value is this minus this. This is the lowest value. So yeah. Yes, and here the same thing. Just so we calculated this figure. Next, we do part A and B provide consistent views of the two projects. Well, consistent view is in the sense like part A and B. Part A says 1600. Part B says 200. You can see here too. 13,000 and 1,700. Very high and very low, consistent. In terms of initial investment and the NPV of 3 situation and ranges, yes. Which project would you recommend and why? Well, it depends on the investors. Depends on the investors which project they want to go for. Okay. But I can see here project A is very risky project. Project B is not that risky, but project A is risky, but at the same time, project A has a higher return as well. Okay. So this project A is risky and high return, and project B, same initial investment, but less risky. Okay. Less risky in there. Yes. All right. Anything else? Oh, okay. Your friend is seeking your advice because he believes you have studied finance, so must be good at making financial decisions. Okay. He is considering investing in a small business that has the following features. The business cost $20,000. Okay. It will generate a net cash inflow of how much? 1,500 in 1 year's time since inception of the project, but the cash flow will grow thereafter at 1.5% per annum. I can see here a constant growth. Okay. I can see here a constant growth. Okay. Your friend requires a return of 8% per annum from the investment. Using the NPV method, recommend whether your friend should invest in the business. NPV is this, NPV is this, NPV is this. So we have to calculate what is NPV actually, right? How do you calculate that? Okay. So you have 4 options, A, B, C, D. Which one you should go for? Well, I'll go for this. I will say insert the formula, equation. Okay. Net present value will be equal to we have our payment in here. So we are receiving a payment of $1,500 in 1 hour's time, and it will be growing at what rate? Will be growing at 1.5% growth rate. Okay. And this is a perpetuity you're talking about. Okay, we're using perpetuity formula in here. Okay. Required rate of return minus growth rate. Okay. You can see here minus your initial investment. That's your formula here. So if you follow these things, here, net present value will be equal to payment is how much? 1,500 divided by required rate of return, which is 0.08. 0.088% minus your growth rate is 1.5%, 0.015, 0.015. Okay. And minus your initial investment. How much initial investment? Your initial investment is actually $20,000. So how much is our answer? Equal to, so 0.8 minus 0. Okay, it will be equal to here 1,500 divided by, it will be 0.065 and 0.06. 0.065 and it will be equal to how much it will be? 1500 by 0.065. Let's do it. It will be around 23,076.92. Okay. This much minus which is equal to how much? 3076.92. That's your answer. Okay. You can make this bold as this thing says bold. Anyway, so that's your answer. The net present value should be 3076.92. The first one is the answer. Okay. If it is, net present value goes above 3076.92. Okay, the answer is A. All right. That's your answer. Okay, and what else we got? Number 4. Okay. I think I'll stop it in just 8:23. I think I'll stop it in here now. I'll stop it in here for today. All right. Do you guys have any question to ask me? And I think the solution for this chapter, for this topic, is also available in Blackboard. You learn in your LMS, Learning Management System, in there. Okay. Yes. Any question for me, guys? No? If there is no question, I would like to close it in here. Any question regarding assignment? No? Golden Core, any question? No question for me? Okay.
No.
Okay. If there is no question, there is none. Okay.
Hello.
Okay. How do you find your email? My email? Okay. My email is this. Is that my email is on the Learner Guide? It should be in there, but let me check. Let me check. It should be there because you're going to send it to me through the email address. So it should be in our Learning Guide. Okay, let me see if it is on the Learning Guide or not. If it is not, definitely I'm going to give you now. I just want to make sure it's in there. Mr. Girija, unit coordinator, program convener. No, my email is not there. No, it's not there.
It's in the first page
The first page.
or second page.
Oh. It's not me. This one you meaning? No.
Yeah.
No, that's not mine. No, that's not me. Okay, I'll give you my email address. Okay, I'll copy this one. My one is similar. Okay. Let me write my email address for you all. That's important, otherwise you guys cannot send me. My email address is not this, but no, it's not. Mine one is this. T dot same. That's it. That's mine. That's my email address. So I'll have to make it available on the chat as well. To not Daniel, to everyone. Yeah. So that's my email address. You can send me. Thank you. Anything else, guys? No? Okay, I'll stop it here then. You have a good weekend and enjoy on your assignment as well. If you have any questions, I think you guys still have next week Thursday class. Gonna ask me some questions too. I think you have to submit on, I don't know, on 17, I think. Yeah, by Sunday. So anyway, you have time. So yeah. And if you have any questions, don't hesitate to ask me, okay? I'll say good night.